Hey, it's Richard with Matthews Wealth Management. We're going to be doing a little mini-series here on inflation, since that seems to be a hot topic nowadays. I thought we'd talk about the three ways that inflation is created, underlying, I guess. So first thing we're going to do is talk about congressional spending or federal spending here. Obviously, we start with Congress, so PPP or stimulus or infrastructure bills or whatever is passed that needs some sort of spending in the public-private sector, like military or bridges or whatever, it is created from Congress, and then they obviously have to go get the money from the rest of the government. So the people that are in charge of the government's money, they're called the Treasury, the U.S. Treasury, which is what it sounds like, except not really. A lot of people kind of envision that Fort Knox filled with gold is the hidden treasure, if you will, of the U.S., and that money is kind of held in one place and then slowly let out as if we're hoarding a bunch of gold or something. That is not the case at all as to how our currency works or our wealth as a nation. Lots of good books written about that. But anyway, the Treasury does basically one thing here. They'll look to see if there's revenue, right? Like if there's enough income tax, federal income tax, corporate income tax, payroll tax, whatever it is for the spending, they're just a pass-through entity, right? So there's no assets held at the U.S. government. There's only income and expense for the most part. Because when the Treasury looks at the revenue or the income, it's not there. We don't have enough to justify the spending that we do, and that gap is what we call the deficit, right? So this should be pretty simple stuff so far. So when we don't have the revenue to offset the spending, we have to do what any of us would do, right? If we have expenses that we can't afford, but we have to fix our tire or a transmission or a water heater, whatever it might be, we usually use a credit card or a home equity loan or a car loan or something like that to buy a house. We get mortgage, right? So debt is basically what our currency is now. It's not an asset. So the Treasury writes bonds, right? And everybody probably remembers growing up with savings bonds. Your parents, grandparents would put money into savings bonds, and they'd buy a $1,000 bond for maybe $700, and over time it grows that interest, right? Or it's $1,000 and it's paying a consistent 3%, or an interest rate that's tied to inflation. So we have double E bonds, H bonds, I bonds, all this fun stuff. But that's basically what the Treasury does when there's not enough money coming into the government to spend, right? So they go into debt. And if you remember bonds back in World War II, we had war bonds where you would give money to the government, loan money to the government, and they would pay you interest over time. It used to be that the citizens and private investors would be the ones that bought these bonds here, but that's not the case anymore. So when we take this bond, investment banks, Citigroup, J.P. Morgan, Morgan Stanley, Goldman Sachs, whoever else you can think of. Investment banks are primarily who are buying these Treasury bonds now. So that is being sold to the investment bank, and the investment bank is paying some cash for it, right? If they have cash, and if they want to hold it, not necessarily, but you'll see here in a second what we're getting at. Investment banks then look at this debt and they say, wow, 30 years and less than 2% interest, that's not good enough, right? Because these banks have to grow, they have investors, and that's not enough margin, not enough profit. So what do? They turn around and take these Treasury bonds and they sell it over here to the Federal Reserve. So the Federal Reserve is the U.S. central bank, so to speak, and they're the ones that are in charge of banking and currency. And whether or not that's constitutional, there's lots of debate about it, but it's the way it is, so this is what we work with. These bonds are coming from the Treasury to the investment banks over to the Federal Reserve. The Federal Reserve says, okay, well, here we go. We will give you some cash for these bonds, and then the investment bank gives this cash to the Treasury, and then this cash goes out through Congress to a bunch of expenditures, right? So that's the gist of it. But the real question that everybody should be asking is, how's the Federal Reserve buying these bonds, right? Do they have revenue coming in? Are they profiting off of student loans or mortgages or something? The answer is no, not really. This is just created out of thin air. I mean, when we say print money, back when we considered that the majority of our money was printed and on paper or coin, that's where that came from. But currently, everything's already digital. You hear about a digital dollar or a digital currency. That is not blockchain. That is not crypto. Digital is basically what we already have. The key to digital currency is more of an oversight situation. So elimination of cash, right, for black market dealings and so forth, which is why crypto is not a great idea from the standpoint of the U.S. government. They don't like that competition. So this money gets created out of nowhere. They buy up these bonds from investment banks who bought them from the U.S. Treasury, and then that money goes to Congress, and then they send it wherever they feel like sending it, right? But this has to come from somewhere, right? So the offset, if you look at this on the Federal Reserve's balance sheet, when we talk about a balance sheet here, these bonds are accumulating, right? And so interestingly enough, it's not just coming from investment banks. Now, the Federal Reserve is buying directly from the U.S. Treasury. In fact, they've been doing 60% of those purchases. And there's a little bit of a joke that we use in the industry that they are now the buyer of last resort. So last year, Matthews Wealth Management had a over allocation towards high yield bonds, which are typically risky, right? We don't want to risk in high yield junk bonds or whatever. But guess who was buying them up? I mean, it didn't matter, right? Because it's going on a balance sheet that just does what it wants to do. So the Federal Reserve has been buying these bonds, not just regular bonds, but also through investment banks, a bunch of other mortgages and high yield bonds. And these investment banks are getting commission and charging fees. And so everybody here on this board is super thrilled. They're very happy. They're making a lot of money here. So $700 billion per month is what the Federal Reserve has been buying, right? So when they buy it, it accumulates up on their balance sheet. And so when we talked about Congress and spending last year, spending from the U.S. Congress did go up by about $6 trillion since the lockdowns, right? And that's what we're starting to feel as inflation as it works its way through. Next two videos will kind of cover how that works. But there's an additional thing to be concerned about. This balance sheet, as it's going up by $700 billion per month, what is that value, right? And so we are now at 8, 9, 2, 6, 1, 2, 8, 0, 0, 0, 0, 0, 0. So not only did we spend $6 trillion from Congress, like this money that just went out into the economy for whatever purposes, right? There's a whole slew of things that we could talk about there, but there's also an $8.9 trillion balance that's parked at the Federal Reserve. So if these assets grow, so does the balance. If these assets shrink, well, so does the balance, which could be a good thing, could be a bad thing, but this is a whole nother layer of inflation leverage that has yet to be liquidated. They're still buying, right? So they're talking about quantitative easing, which is inflating this number, making this number bigger. Well, now they're going to back down on quantitative easing, which means they're not going to grow it at 700 billion per month, maybe only 500 billion or 100 billion or whatever that amount. It's still growing, right? And the value of these assets could also be growing depending on what the underlying asset is. So just a whole nother floodgate that could open into the world of inflation. Not to spook you too much, but at least now you kind of know the gist and the principles of how money is created from the Federal Reserve, who it goes to, and then an additional problem that we're not even fully aware of. This is not audited because they're a private bank. So anyway, big influence on our country, and we're just guessing at that number or taking it at their word. But that's a lot more inflation that could be on the way. Come back for the next two videos, and we'll talk a little bit more about different types of inflation.